أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله والصلاة والسلام على رسول الله وعلى آله وبارك وسلم. Dear students, Assalamu alaikum. I welcome you all to International Financial Management subject video lecture series. Inshallah, in our today's lecture we'll start chapter number 3, which is International Financial Markets. In this chapter we'll have main discussion on different international financial markets, and these are the chapter objectives. Due to growth in international business over the last 30 years, various international financial markets have been developed. Financial managers of multinational corporations must understand the various international financial markets that are available so that they can use those markets to facilitate their international business transactions. The basic objective of this is to describe the background in corporate use of international financial markets. So basically in this chapter we'll have discussion on understanding the various financial markets which are available for the multinational corporations to facilitate the international business transactions. We'll understand how multinational corporations use these international financial markets to facilitate themselves while they are doing international business transactions. We'll have a big round discussion on the and the corporate use of these international financial markets. So basically the main discussion is going to be on how first of all what are various international financial markets and how they facilitate multinational corporations, and how multinational corporations use these multinational or international financial markets while they are making international business transactions, and also what are the corporate use of these international financial markets, and obviously we'll have the background discussion on these international financial markets at the beginning. So today we'll have discussion on the international financial markets, and it's going to be an introductory discussion. We'll get to know basically what are different international financial markets, and what are the main functions of these international financial markets. All right, so we begin first with the definition of international financial market. International financial market is a financial market where individuals buy and sell foreign assets such as stock, bonds, and different currencies, especially international currencies, especially those currencies which are widely accepted and which are widely used by different companies throughout the world. So a market where international or foreign assets, which are stock, bonds, and currencies, are bought and sold by the individuals, that market is called international financial market. Later on we will have discussion on who are those individuals which buy and sell those foreign assets, means stocks, bonds, and currencies. But now we'll discuss what are different international financial markets. So number one, we have foreign exchange market. Number two, we have euro currency market. Number three, euro credit market. Number four, euro bond market. And number five, international stock market. We'll have in discussion can say a primary discussion or a preliminary discussion or an introductory discussion on these five individually in our today's lecture, and at the end we'll have a comparison. But in future lectures we'll pick these markets one by one, and we'll have detailed discussion on each single one of these international financial markets. But today we'll have a short introductory discussion on each individual one. So let's begin with the first one, the foreign exchange market. It's the market where participants are able to buy and sell, exchange buy and sell, exchange and speculate on currencies. So basically on foreign exchange market, the participants means buy and sellers. And who are those participants? They are listed down there, but let's see what these participants do on foreign exchange market. Usually the participants of the foreign exchange market, they do 4 activities on these foreign exchange market. Number 1, they buy currencies, they sell currencies, they exchange currencies, and they speculate currencies. So buy, sell, exchange and speculate. While they buy currency, this purchase of currency could be in order to make a payment on another currency against the purchase of goods and services. Similarly, they sell a currency in order to pay for their debts, or maybe they exchange a currency from one to other in order to pay their dues. When it comes to speculation means they have an intention to invest in a foreign currency. They purchase a foreign currency with an intention that that currency will be held by them for a certain period of time, which will have overall impact on the exchange rate of that currency, with an intention to earn some profit on that. So when they buy the currency from the market, basically that currency is injected out from that from that market, and there is an artificial demand created for that with less supply. So as a result, the price of that currency increases after a certain period of time. When the price reaches to a certain peak or high, it becomes high, then these participants sell out that currency and generate profit. Sometimes this profit is a huge amount. So overall, in these 4 activities, there is always a profit or a loss. If we buy or if we sell or if we exchange or we speculate, there is always a possibility of profit or a possibility of loss due to this exchange, or due to this buy and sell, and due to this speculation. So basically there are 4 types of participants who participate in the foreign exchange market, who we call them the elements or the components, or we can say the participants or buyer and sellers of the exchange of the currency on the foreign exchange market. Number 1 are banks and commercial companies. By banks we mean commercial banks, private banks, right? And commercial companies could be any company. Central banks are held by the government, so different governmental central banks also participate. Investment management firms, they are specialized firms whose job is to do investment management. We have hedge fund companies, we have retail forex brokers and investors. So basically these 5 group of people or participants or companies or organizations, they participate in foreign exchange market. They buy, they sell, they exchange, and they speculate on currencies. And through this process, they not only fulfill their desired objective, but also they earn a huge amounts of money on foreign exchange market. Okay. Next we have euro currency market. Remember that we will discuss foreign exchange market in details in upcoming lectures, but for today we'll have a short discussion on each one. So we have a concept of what basically the four international financial markets are. Number 2, we have euro currency market. It is also called the money market, in which euro currency is borrowed and lent by the banks in Europe. So this market is basically in the European territory. In this market, European banks borrow euro currency and lend euro currency. The currency is held in banks outside of the country where it is legal tender. For example, dollar is a legal tender in United States. It is kept outside that. It's kept within the Europe. Or similarly, if we say if German currency is legal tender in Germany, it's kept outside Germany. In other European territory countries, they are held by the bank and lended out and accepted as a deposit. It's utilized by large firms and extremely wealthy individuals who wish to circumvent regulatory requirements and tax laws. Basically, euro currency market are used by wealthy individuals and extremely large firms in order to be away from the regulatory requirements and also from the tax laws. They earn money somewhere else, but they put that money in somewhere else. For example, most of the currency money, wealthy people, they deposit their money in Swiss bank. So Swiss is one of the European countries. Next, we have Euro credit market. Euro credit market is basically the market where financial banking institutions provide banking services, accept deposits, and provide loans denominated in foreign currencies. The banks that constitute this market are the same banks that constitute the euro currency market. The difference is that euro credit loans are long-term than so-called euro currency loans. Remember that it's the same market, but due to the duration or time period, there is difference in name. If the acceptance of deposit and provision of loan is for shorter period of time, that market becomes euro currency market. That's why it's called money market, right? If the same loans, the same acceptance of deposit and provision of loans is for longer period of times, then that becomes the euro credit market, right? The operations are same, the currency is same, the main participants are same, but the only difference between the euro currency market and euro credit market is the time period. It's for short term and this is for long term. Next, we have euro bond market. From the name we can infer that this market belongs to the bonds, a market in which bonds are issued in capital market of one currency to a non-resident borrower from another currency. The euro bond market is made up of investors, banks, borrowers, and trading agents that buy and sell and transfer bonds. So basically, in euro bond market, there are bonds issued by issued in the capital markets by larger firms to the international investors. For example, an American company issue bonds only to a non-American resident. So the market where a non-American resident buys an American company bond, that market is called euro bond market, and that is usually for longer period of time. Usually in this market, investors from across the world, banks, commercial banks from across the world, similarly borrowers from across the world, similarly trading agents from across the world, they buy the euro bond markets on lower price and then they sell them on the higher price. Similarly, they transfer one euro bond to another euro bond in that euro bond market. Euro bonds are special kinds of bonds issued by European governments and companies, but often dominated in non-European countries such as dollar and yen. So euro bond market is only for special type of bonds which are called euro bond, and euro bond are issued by European government companies, and they are dominated in non-European countries such as in countries where dollar is a legal tender, in countries where yen is a legal tender. They are also issued by international bodies such as the World Bank. These euro bonds are also issued by the World Bank. A European bond is an international bond that is denominated in currency not native to the country where it is issued. For example, the bond belongs to European countries or the World Bank, but they are not issued within the Europe. They are issued to the international investors, international borrowers, international trading agents, right, who are not native to that bond holder or the bond issuer. Understood? Next, we have international stock market. International, from the name you can see stock market. Before we had international bond market or euro bond market. Now we have international stock market. In the stock market, international stock market, stocks are traded or issued by the investors and by the participants. And this is the market where shares of the multinational corporations are issued and traded. It's also known as equity market or capital market. It's one of the most vital areas of market economy, as it provides companies with access to capital and investors with a slice of ownership in the company and the potential gains based on the company's future performance. So this is one of the most important markets around the world. In this market, multinational corporations issue their stock. By issuing the stock, they do financing. They gather large amount of funds from the investors around the world, and that funds are utilized to further grow the company. Similarly, the stockholders becomes the owner of those international companies to the extent of their investment, and also they receive the dividend annually from those international or multinational corporations, and also they can gain from the price change, which is called capital gain by trading, by buying and selling over time again and again on the international stock market. This market can be split into two main sections, primary and secondary. The primary is where new issues are first offered with any subsequent trading going on in the secondary market. So stock market has two sections, primary stock market and secondary stock market. In primary stock market, multinational corporations issue the shares, and the first hand purchase of those stocks happen. In the secondary market, the second hand and third hand buying and selling, which is called trading, that takes place on the secondary market. Okay, now comparisons of international financial markets. Now let's compare the international financial markets. So we can see the differentiation between each and how we can use different markets for different purposes. The foreign cash flow movements of the typical multinational corporation can be classified into four corporate functions, all of which generally require the use of foreign exchange markets. Number one is foreign trade, number two is foreign direct investment, number three is short-term investment, number four is long-term investment. So these are basically four different types of corporate functions of the multinational corporations. Corporate functions means four type of functions where there is involvement of cash flow, cash coming in, cash going out to the multinational corporations. So if someone asks you what are the four corporate functions of a typical multinational corporation, which involves cash flow or movement of funds from one country to other country affecting the foreign exchange market, so we will say foreign trade, foreign direct investment, foreign short-term investment, and long-term investment. Foreign trade, it's basically when exports generate foreign cash flows while exports require cash outflows. When there is export and import, and it's one of the functions of multinational corporations that they have foreign trade. When they do foreign trade, there is involvement of cash flow, which is as a result of exports, there is cash inflow. When multinational corporations export the commodity, there is cash inflow. When those multinational corporations imports the commodities, there is cash outflow. Second, we have direct foreign investment. When multinational corporations make a foreign investment or do an investment in other countries, that becomes the outflow, right? But when there is other people invest in that multinational corporation, that becomes the inflow. For example, there is an American multinational corporation, and that multinational corporation invests in China, that is the outflow. But when Chinese people invest in that American company that invests their money, that becomes the inflow for that. So from direct foreign investment, there is always cash flow is involved. Next, we have short-term investments of financing in foreign securities, usually in the euro currency market. When multinational corporations do short-term investments or do short-term financing, when they do short-term investments, it's outflow. When they do short-term financing, it is the inflow. So this investment and financing, which is short-term, this takes place in the euro currency market, and it's done by the multinational corporations. If the same financing and investment is for longer period of time, if it is for longer term, then the multinational corporations do that through euro credit market or euro bond market or international stock market. If a certain currency is borrowed for longer period of time, it's euro credit market. If a certain currency is lent out by the multinationals, it's outflow, euro credit market. Similarly, if multinational corporations sell bonds, euro bonds, it's on the euro bond market. So for a longer period of time, it's the inflow for them. If they purchase euro bond on the euro bond market, it's the outflow of cash for them. Similarly, if they issue stock, they generate money, it's inflow of money for them. It's on stock market. But when they purchase back the stocks from the investors, that becomes the outflow, and that is also on the stock market. So basically, there are four functions of the multinational corporations, which involves movement of money, flow of money, which is inflow and outflow, and we studied that where each functions takes place. This function is on foreign exchange market. This function is on the foreign exchange market also. This function is on the euro currency market, while this function is on the euro bond market, euro credit market, or international stock market. So that is the differentiation between the companies with respect to the functions of the multinational corporation. This is a cash flow chart of a multinational corporation, right? We have the parent or the headquarters of the multinational corporation. They do five types of functions. Number one is export import. Number two is dividend remittance and financing. Number three, short-term financing and investment. Number four is medium-term financing and investment. And number three is foreign exchange transactions. So export import, foreign business clients, it's done through foreign business clients, and there is import or export, it's also done by the subsidiaries. Subsidiaries, it's the dividend remittance and financing. Sometimes foreign subsidiaries, when they generate net profit, that net profit is announced at the end of the period as a dividend, so it comes to the multinational corporation. And sometimes when they are in need of money, so multinational corporation, they provide funding to those subsidiaries, that becomes financing. So dividend remittance by the subsidiary to MNC parent company, that is the inflow, but financing by the parent to the subsidiary, that is the outflow. Next, we have short-term investment. Sometimes multinational corporations need short-term investment and short-term financing. That is done through the euro currency market. And similarly, subsidiaries also require short-term financing. They also do it through the euro currency market. Similarly, sometimes the multinational corporations and their subsidiaries they are required to do some medium-term financing or investment. That is done through the euro credit and euro bond markets. And when the multinational corporation's parent or the subsidiary, they are in need of long-term financing, that long-term financing is done with the help of international stock market, right? And also, these multinational corporations and their subsidiaries, they also do foreign exchange transactions, and those foreign exchange transactions are basically with the help of foreign exchange market. So we can now see how multinational corporations and their subsidiaries utilize different international financial markets, that we have foreign exchange market, euro currency market, euro credit and euro bond market, and international stock markets, how they are utilized, for what purpose, medium term, short term, long term financing and investing, also remittance of dividend and funding through MNC to subsidiary. Similarly, when they export and import, they use the international financial market, and this is how flow of funds takes place, and that this is the flow chart of the multinational corporation. Okay. Now, motives for using international financial markets. The question is, why multinational corporations use international financial markets? What urges them to use these markets? The markets for real or financial assets are prevented from complete integration by barriers such as tax differences, tariff differences, quotas, labor mobility, cultural differences, and financial reporting differences. We know that multinational corporations, they operate in different countries, so they face the difficulties of tax differentials, tariff differences, quota differences, and we know that labor is immovable. We know that there are cultural differences. We know there are financial reporting differences. Each country has different tax laws, different tariff laws. Each country has different quota systems, and also we know that moving labor from one country to other country is impossible. And there are cultural differences, and there are financial reporting differences. And these all differences and difficulties are faced by the multinational corporations because they operate in different countries. But these barriers are unique opportunities sometimes, right? And when these barriers becomes opportunities, that's when multinational corporations and the foreign investors are attracted, right? So there are three types of agents that participate in the international financial markets. Number one, we have borrowers. Number two, we have investors. And number three, we have creditors. These are basically the agents or the people who participate, or we can say the participants of the international financial market that we discussed in our first slide. Borrowers, investors, and creditors. So let's talk about them one by one. Why do the borrowers participate in the foreign markets? To capitalize on lower foreign interest rates, and when they expect foreign currencies to depreciate against their own. So that there are two main reasons when borrowers participate in foreign markets, which could be any of those 5 international financial markets. Number two is investors. Investors also have 3 reasons to participate on the international financial markets. Number one, to take advantage of favorable economic conditions, and number two is when they expect foreign currencies to appreciate against their own currency, they invest. And number three is to reap the benefits from international diversification. So these are 3 main reasons when investors invest in the foreign markets. Number 3, creditors. Why creditors participate in the international financial markets? There are 3 main reasons for them as well. Number one, to capitalize on higher foreign interest rates. Number two, when they expect foreign currencies to appreciate against their own currency. And number 3, to reap the benefits from international diversification. So if we look at investors and creditors, somehow number 2 and number 3 reason is same, but first reason is different. The investors, they want to get the benefit of better economic conditions, while the creditors want to get the benefit of foreign interest rate. Similarly, if you look at the borrowers, they capitalize on in order to get the benefit of lower interest rates. And also, if you look at them, the borrowers invest when the currency depreciates, but the investors and creditors invest when the currency appreciates, right? And also, they also get the benefit of international diversification through the participation on the international financial markets. So that was all discussion, all our discussion for today's lecture. I hope it was somehow beneficial to you, somehow understandable to you guys, and I hope that you guys have understood the international financial markets on introductory level. So basically we had discussion on these 5, and then we had the comparisons between both of them on 4 corporate functions, based on the 4 corporate functions of multinational corporation. And similarly, we discussed the flow chart of the multinational corporations, and then we had discussion on why the participants are motivated to basically use international financial markets. And then we had discussion basically who are the participants or agents. So there were 3 types of people: borrowers, investors, and creditors, and they are different from one another based on the purpose of their use on the financial market. Hope it's clear for you. If you have any questions, please get back to me. I'm more than happy to help you with your questions and to resolve any sort of ambiguity that you have in your minds. Take care of yourselves. Stay home, stay safe. Wassalamu alaikum wa rahmatullahi wa barakatuh.